Good evening, Prof. Dr. Jerome Yamana. I am from Group I, Damon Putty, leader, Martin Arul, and Vikesh Sharma, my group members. I'm here to just to make the presentation on strategic management group assignment, and our due date is on the 7th of September, 7th of October, not 7th of October 2025. Okay. 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 The presentation is we are giving a company overview and strategic intent. We have selected Kekseng Malaysia Berhad as the main and SD Guthrie Malaysia Berhad. SD is actually stands for Saindabi Guthrie Malaysia Berhad. Kekseng is a company which is formed in 1943, where Mr. Ho Yao Kun was a co-founder of the trading business based in Singapore. In 1959, the company acquired land in Masai, and during that time it was a rubber plantation, and in 1965, diversified oil palm cultivation. And Kekseng was listed in the Bursa KLC on 26th of May 1977. Whereas Saindabi Guthrie Malaysia Berhad is a company which has been rooted for 200 years. It's a European company, trading house in Singapore in 1821. It became part of Saindabi Plantation, and it is involved in palm cultivation, estates, refineries, oils and fats, etc. as a downstream operation from palm oil. In 1924, the company formally changed its name from Saindabi Plantation to ST Berhad, signaling a strategic shift from technology-driven company to digital company based on plantations and upstream segment. While in the downstream business, we have renewable energy industrial in the core. Okay. On Kekseng, oil palm cultivation is integrated malt mill, kernel crushing, refinery, refined and oil fats, especially fats and nutraceuticals via super vitamins. Master plan townships is on residential launches, then commercial residential properties where we have in Kekseng and Regency Tower. The only operation of overseas hotels and golf resorts in Malaysia. Kekseng is also a player in Malaysia, especially in Johor, in revenue streams across plantations, manufacturing, properties, hotels, and resorts. Rationale for selecting this company is diversification. Kekseng operates across multiple sectors. It's chosen because it's chosen on multiple sectors. Like agriculture, manufacturing, property, and hospitality. On sustainability as given in palm oil property development. It is also relevant to use how the company is responding to sustainability 10 years. Emerging is also as emerging digital demands as government hotels and plantation factory. Investors increasingly demand in ESG's performance, transparent long-term values, not just on short-term. Kekseng is at a junction where enhancing mission to reflect those may help strategic clarity. Current vision and mission of Kekseng. Vision is to build a diversified corporation to provide sustainable long-term growth and value to stakeholders. Values is integrity, commitment, diligence, cost efficiency, belief in contributing to and growing together with communities, continuing social beneficial activities. The vision is clearly simple and high level. It emphasizes diversification plus sustainable long-term growth and shareholder value. However, the mission is not exactly implicitly labeled in the report, or at least not as long separate mission statement. The vision covers both what the company wants to become, a diversified corporation, and what it wants to deliver, sustainable long-term growth and shareholders. On the relevance, the emphasis on shareholder value and diversity is relevant given the business mix, but increasingly other stakeholders. Current vision doesn't implicitly mention sustainability, environmental or social dimensions, nor digitalization or innovation beyond one of all of the values. Alignment with industry trends. The trends in agribusiness and production include transferability, zero deforestation, renewable energy, emission reductions, supply chain transparency, investor ESG demands, trends in property development and hospitality, digital customer interfaces, outline hybrid demand, climate design. The current vision partly aligns diversification, long-term growth, but there is room for strengthening in describing broader stakeholder value, environmental sustainability, digital transformation, on rewriting vision and mission to reflect digital transformation, leading diversified and sustainable group, creating long-term value for all stakeholders, innovation, environmental stewardship, digital excellence, mission specifying businesses, leverage cutting-edge digital technologies and responsible practices. On the part two, second part is corporate level strategic direction. On diversification, to analyze the organization's existing corporate strategy is diversification. On the segments is plantations, oil palm cultivation, processing, manufacturing, refined palm oil, specialty oil fats, nutraceuticals, property development and investment, hotel and resort, geographical spread, operating in Malaysia, Singapore, Hong Kong, Canada, for hotel properties, downstream and upstream in plantation business, they control upstream palm cultivation, then milling, refining, and further downstream, especially oils, nutraceutical ingredients. Vertical integration, they have integration across the palm oil value chain, from fresh fruit bunches, cultivation, milling, refining, fractionation, specialty oils. Some property investment on the hospitality arms are somewhat independent, but Landmark ownership gives options for both development and investment. Internationalization, hotels and resorts in overseas markets. Canada is an investment outside Malaysia. In plantation management property, the main focus is Malaysia as well, Johor especially with some Singapore, Hong Kong exposure. Asset and landmark monetization, the group has significant land banks, especially in Johor, which they are using for property development and investment property, townships, residential, commercial. Recently exposed of their stake in Parkway Holdings in Singapore to raise cash. Please, management and financial strategy. They maintain a net cash position in some periods despite losses in some quarters, indicating financial discipline. They are cautious about new property launches due to inflation of materials, labor costs, cautious about internal micro risks such as current geographical ESG compliance. For ESG and sustainability, the plantation division shows certifications MSPO, RSPO for sustainable palm oil. Stakeholder engagement, no one left behind practice with 3 Ps, profit, people, planet in their sustainability statements. They declare commitment to biodiversity, minimizing emissions and avoiding deforestation. On assessment, alignment with the sustainable competitive advantage and mission vision. Mission explicit publicly available information does not show a clearly stated formal version of mission and vision in many sources, or at least not in the main format. The mission for the property division appears to be timeless quality and good value, delivering quality and good value properties. Using tools and theory, resource-based value view, taxing resources handle large bank in land bank in Johor, vertical integration in Park Mall, established property business and development experience in overseas hospitality, competitive positioning, fit SNG external environment, scale in plantation, refining, and seed R&D, strong ESG credentials, technological adoption and operational efficiency, dependence on community series and opportunity costs, focus dilution, strengths and weaknesses of current strategies. Strengths are vertical integration in plantation manufacturing gives cost control and margin capture, large and valuable land bank property development upsides. Diversification reduces dependence on one business. ESG credential give mitigate risk, open up premium markets, sole financial base in many areas, and ability to monetize assets. Alignment with the vision, mission proposed imply the sustainability ESG efforts plus move into renewable energy, land monetization, industrial lands, and innovation suggest seeks to be more than just a raw plantation company, to be diversified, sustainable agriculture and land development and plus energy player. Weaknesses, exposure to commodity cycles, currency, foreign risks, especially overseas, rising input costs, property development risks, more transparent and strong governance may be required. Proposed changes to corporate strategy, sharper portfolio focuses and pruning, accelerated ESG sustainability investment, technology adoption, digital transformation, value-added product development, land bank monetization and real estate, climate risk management and resilience planning, governance and stakeholder engagement with local communities, indigenous lives and workers, expansion into new markets, products, justified recommendation using strategic management theories was unsolved metrics using unsolved metrics, market penetration, product development, market development and diversification, increase market share in existing segments in Malaysia, develop new products, especially oils and nutraceuticals, biofuels, sustainability brand oils, expand into new geographic markets for existing products, export refined oils to ESG sensitive markets, consider diversifying into renewable energy, solar, biomass from palm oil waste, BHG growth and share metrics, cash cost, plantation manufacturing plus manufacturing, if margins are good for property development in mature markets, Johor townships, generate steady cash flows, assuming property markets are strong, stars, specialty oils, nutraceuticals, fit if demand rising, potentially ESG certified green offer products and hospitality in growing tourist markets if well managed. BSG growth and share metrics, diversification, landmark development, industrial parks, renewables, possibly agriculture, alternates of value much upstream already. Plantation and oil palm upstream business is likely a cash cow given scale through emerging verticals like renewable energy and industrial park development are question marks, potential stars depending on execution. On business level and functional strategies, Keqing Malaysia on cost leadership elements, differential elements, focus on strategy hybrid. Many of the property developments are regionally focused, Johor and South Johor. They serve a geographical focus. They have a diversified portfolio which may permit cross-business synergies, but also requires balancing different competitive models. Keck Seng's business level strategy as a hybrid, a mix of broad cost leadership, mainly in its manufacturing, refinery, and property cost control, combined with diversification in budget hotels investment and experiential lifestyle residentials. They are not strictly pure cost leaders or pure differentiators. Rather, they seek to maintain cost competitiveness while offering quality, amenities, and brand where it adds value. Effectiveness, market share, profitability recent years show that the property and the hotels segments have helped drive profit increases that has been for weaker in some quarters due to demand margin pressures. SD Qatari's diversification into land development, industrial parks, and renewables is but promising in terms of unlocking value, reducing dependence on volatile commodity prices. The property diversification saw strong sales uplift. Market share asset strength. Keck Seng has large land bank in Johor, investing property in prime locations and overseas hotels. There are assets that provide leverage. Also, they are launching many new residential units, and occupancy in investment property and rentals seems to be healthy in many cases. Challenges, external headwinds, commodity price volatility, labor cost rises, especially in manufacturing foreign risk, rising material costs in property development, reduced margins. Applying Blue Ocean strategy to use Blue Ocean more concretely, Keck Seng could eliminate things because the customers don't value much, but cost them. There is overbuilt amenities under the underused hotel spaces. Overemphasis on luxury when travelers are more interested in experience plus value, reduce unnecessary cost practices, raise service levels in selected properties, create new products and or services on co-living. On item 4, on internal and external strategic analysis, on SWOT analysis, Keck Seng's strengths are diversified business mix, meaningful revenue based from manufacturing plantations, international hospitality footprint and brands, sustainability credentials in plantation, established corporate governance processes. Weaknesses, relatively smaller scale versus major Malaysian conglomerates, limits bargaining power, access to large-scale projects, and diversification compared to peers. Example, Sunway, exposure to commodity price volatility, CPO prices, plantation manufacturing are price sensitive. Currently, forex also affect overseas hotels and remeasurement. Concentrated landmark regional presence, property revenue focus on Johor and selective markets, less geographic diversification compared with large national developers, operational complexity across geographies and sectors, managing plantations, plantation ESG compliance, property developments. Opportunities, recovery and growth in global travel, improved tourism, boost hotel revenue power, particularly for international branded hotels, higher margin property projects and strategic land monetization, value-added vertical integration. Weaknesses, commodity dependence, exposure to labor and labor and supply chain constraints, relative visibility versus giant buyers, downstream scale and product diversification, opportunities, premium for certified sustainability palm oil, value-added downstream oil expansion, productivity in agri-tech, ESG sustainable palm oil premiums, and strategic partnerships, asset recycling. On the threats, we got micro risk, clinical property market, interest rate, environment, construction, cost inflation, commodity risk and regulation, volatility in CPO prices, stricter sustainability regulations, or buyer restrictions could reduce margins. Intense competition from major integrated commodities, forex and geographical risk for overseas hotels, USD, and current currency exposure, travel restrictions, strategic conversions at low yield land, long-term offtake and supply agreements. The threats is CPO price volatility, regulatory market ESG pressures, labor and logistic disruptions, competition from very large multinational planters. On industry and environmental analysis, fixing on Porter's 5 forces analysis, threat of new entrants moderate, bargaining power of suppliers moderate to high, bargaining power to buyers high, threat to subsidies moderate, competitive rivalry high, environmental consideration across the 5 forces, force, new entrants, environmental regulations, suppliers, buyers, substitutes. Okay. On pestle analysis, policies in Malaysia and other producing countries, Indonesia, Papua New Guinea, Solomon Islands on land use, foreign labor, forest permit regulation, trade regulation, import restriction, anti-deforestation laws, government incentives for renewable energy and industrial parks, volatile CPO palm oil, crude palm oil, rivalry in environmental leadership, low emissions, sustainable sourcing can be competitive edge on a weakness if neglected. On pestle analysis, government policies on land use, zoning, permits, and urban government stimulus policy support for property tourism, geographical tensions affecting supply chains and currency, trade and tariffs policies, inflation, interest rates, currency in fluctuations, tourism demand, global demand and prices, consumers' preferences, demographic trends, social acceptance of environmental, labor supply and wage expectations, cost pressures, exchange rate fluctuation, demand patterns, labor issues, commodity expectations, consumer awareness mechanism, automation, digitalization in plantation, innovation in downstream processes and product, renewable energy technology, deforestation, climate change, carbon emissions, water management, construction technology, digitalization, property, plantation technology, online, offline market sales for climate changes, environmental regulation, pressure for green buildings, carbon emissions, land laws, environmental laws and permits, labor laws, health and safety, building codes, regulatory compliance by exports, taxation tariffs, sections tariffs for strategic implication for catching diversification and risk hedging. Considering increasing or securing income streams, tightly managed construction, planting and manufacturing need yield improvement. Hotels improve average room rates, occupancy via targeted marketing, optimizing costs, strategic timing of property launches, then strengthening of ESG environmental compliance, leveraging technology and innovation, financial strategy and capital management, Strategic leadership for implementation, board and executive leadership structures. The managing director is overall responsible for financial performance as well as development of the company's strategy. The board has oversight over risk, reasonable matters. It ensures monitoring and that policies and strategies adopted are implemented throughout the organization. There's a diversity policy in place, gender, ethnicity, experience for board and senior management, governance and ethics to have formal policies, ethics policy, social policy, sustainability certification policies, internal audit, risk committees, compliance functions embedded in structure, sustainable and stakeholder management, strategic diversification, responsive to market and external conditions, strategic implementation, annual reporting, strategy communication, portfolio project execution, risk management, internal controls, sustainability, compliance integration, financial and capital management. How the leadership will influence organization culture, change management, leadership, organization culture, top-down value settings, cultural states and influence by leadership and change management, leadership's role in change, leadership and stakeholder management. We have stakeholders, internal employees, management leads, board members, external shareholders, transparent reporting, stakeholder engaged platforms, long-term shareholder value. Finally, on the strategic recommendations and conclusion, 3 actionable strategic recommendations for short term, 1 to 3 years. Strengthen profit margins via operational efficiency in manufacturing and production solutions. They can conduct value chain efficiency audit across plantation manufacturing preparations. Invest in mechanization and automation, example in drone-based crop monitoring, AI for yield prediction to access premium markets for sustainability certified products at better price. Expected benefits improve cost structure and operational resilience, enhance competitive position in volatile commodity markets, stronger alignment with ESG conscious buyers and regulators, monetize, optimize unutilized property assets, conduct a portfolio review to identify non-core or low result ROI value, launch acceptable build to rent and mixed-use development projects in high-demand corridors, consider joint ventures with local developers or partners to de-risk capital exposure. Expected benefits increase recurring revenue, improve ROA return on assets on cash flow, better strategy focus on high potential locations and segments, enhance stakeholder trust, ESG transparency, digital communication, publish a standalone annual ESG report, assigned with global frameworks, launch a digital stakeholder portal for investors, communities, employees to report on grievances, project updates, certificates, etc. Run ESG awareness and compliance training across all subsidiaries. Expected benefits, stronger reputation with investors, banks, and regulators. Reduce ESG-related risks, example, sanctions, boycotts, and improve employees and community. In closing this this presentation, we conclude that operational efficiency on plantation manufacturing improves margins of productivity, asset monetization, property investment, maximize returns on capitals, ESG transparency, cross-sector can build trust, meet compliance to ESG demands. 3 actionable strategy recommended protection ratio over the short to medium term, 3 to 5 years, expand high value property development in growth corridors, We get expected outcomes are stronger, more resilient revenue stream from real estate, long-term asset acquisition, and higher brand equity as access to new customer segments and incentive program. Invest in downstream integration and branded farm-based products. Expected outcome based margin enhancement and diversification of revenue sources, greater brand visibility and pricing power, digital transformation, operation and customer engagement. Expect outcomes, cost savings through operational efficiency, automation, and justifying recommendation with strategy management models and real world best practice exchange, focusing on scalable mixed use township development plus improved capital recycling plus operational decision plus ESG leadership for protecting plantation hospitality cash flows. Recommendation below is mapped to models and real world practices with KPIs and quick. We can double down on integrated mixed use township projects. Unsolved perspective is product market development, real world best practice, is like, especially like Gamuda, Sunway, and SP Setia successfully use master plan townships to extract recurring income. BCG portfolio thinking and financial strategy is to recycle capital from mature low growth assets into high return developments. Real world best practices, Sunway has successfully used asset recycling to fund growth. KPIs, net debt, equity, gross cash diversion cycle, proceeds from the disposal, cost of capital, digital skills, PropTech, and customer recycle, then real world best practices, protect and monetize plantation and hospitality assets, strengthen governance project delivery and IBS adoptions to reduce costs. Real world best practice, Gamuda uses digital and offset construction and claims consistent improvements in delivery and living quality, adopting IBS to reduce tasks. Strategic management models is SWOT and PESTEL frames external risks on regulation, economy cycles, climate, and internal strengths, land bank, diversified operations. Porter's five forces justifies moving from pure commodity housing to mixed-use townships and niches to lower rivalry and supply bargaining risk. Unsolved and BSG use BSG to allocate capital mature plantation hotel to the cash cow and mixed-use buildings close to star potential. Balance scorecard used for internal alignment, financial, customer, process, people. Top three near-term priorities: run asset audit and capital recycling plan. Select one land parcel for integrated township pilot using accessibility and digital sales as core differentiators. Publish an ESG roadmap plus target green financing to unblock financing and PR benefits. So so far we conclude that all those requirement has been addressed and has been addressed, and we will present you the citations, references of Keck Seng Malaysia Berhad.